In a previous video, I discussed debt to income ratio and explained how to accurately calculate your personal DTI. But have you ever heard of housing expense ratio? If you're not sure what it is and why it's so important, don't worry, I've got you covered. By the end of the video, you'll know exactly what housing ratio is, how to calculate it, why it matters, and how it's different from your overall DTI. If you're new here, my name is Shakelia LeBlanc. I'm a mortgage loan officer, certified veteran lending specialist, and I help families say hello to their new home. Let's jump into it. All right, so first up, what exactly is your housing ratio? In simple terms, housing ratio, which is also called the front end ratio, is the percentage of your gross monthly income that goes toward your monthly housing expense. Typically, we abbreviate the expenses with the letters PITIA, which includes your mortgage principal, and that's your principal and interest, property taxes, homeowners insurance, and any association, HOA, or regime fees. Basically, it's how much of your income goes towards making sure just your home is covered. Now, if you are wondering how your housing ratio is different from your debt to income ratio or DTI, the difference is very simple. Housing ratio or front end ratio only looks at your housing expenses. Again, that's mortgage, taxes, insurance, etc. While your debt to income or the back end ratio includes all of your monthly debt. So along with your housing expenses, we add credit cards, car payments, student loans, and other debt that you may have. So housing ratio focuses just on what it costs to live in your home, while DTI looks at your overall financial situation. The housing ratio is important because lenders want to make sure you can comfortably afford your home without putting too much of your income in your housing costs. Lenders use it to make sure your housing costs are manageable and that you won't be stretched too thin financially. The lower your housing ratio, the more financially stable you look in the eyes of the lender. A good housing ratio shows that you have enough income left over after paying your housing expenses to cover your other living costs, things like groceries, utilities, and maybe even some fun stuff like eating out or traveling. Okay, so how do you calculate your housing ratio? It's actually pretty simple. Here's the formula. Housing ratio equals total monthly housing expenses divided by gross monthly income times 100. Let's walk through an example. Let's say your total monthly housing expenses, mortgage, property taxes, homeowners insurance, and HOA fees come out to $1,500. Your gross monthly income before taxes and deductions is $5,000. So here's the calculation. $1,500 divided by $5,000 times 100 equals 30%. If you want to use the housing ratio to determine how much you can afford, then you would use this calculation. Gross income times housing ratio equals total housing expense. Using the same scenario above, here's the calculation. $5,000 times 0.30 equals $1,500. Now let's talk about the maximum housing ratios for the main loan types. Lenders have different guidelines depending on the loan program you're using. Here's a quick breakdown. USDA loans. The max housing ratio is 34%, but it's typically harder to get approved over 29%. FHA loans are capped at 47%, and conventional loans are capped at 50%. VA loans do not have any specific housing ratio requirements. Let's take a look at this chart to show examples of housing ratios based on different income levels. You can see there's a big difference in the payments when using a 47 or 50% housing ratio versus 30%. Please keep in mind a few things. Your specific lender might have slightly different rules, including lower or restricted housing ratios. These are the max guidelines, and often, in order to qualify for max ratios, you have to have compensating factors like higher credit scores or reserves. And number three, just because you can qualify for the max does not mean you have to accept it or that it's right for your situation. A healthy ratio is generally considered around 30% or lower of your gross income. So if you are approved for a higher expense ratio, you have to truly contemplate what life would look like for you with a mortgage encompassing so much of your income. The goal is to make sure that your housing costs aren't eating up too much of your monthly income. And remember, this is gross income. It's not your actual take-home pay. If your housing ratio is too high, I have a few tips on what you can do. Number one, increase your down payment. The more you put down, the lower your mortgage payment, which will reduce your housing ratio. Number two, shop around for insurance. Homeowners insurance costs can vary, so shopping for a better rate could lower your monthly expenses. Number three, look for a home with lower property taxes. Some areas have much lower property tax rates, which could help reduce your overall housing costs. And number four, similar to DTI, you can always work on ways to increase your income. The key is to keep your housing ratio within guidelines for the loan program you're using, while also making sure you're comfortable with the payments. And there you have it. That's everything you need to know about housing ratio. It's a simple but super important factor in making sure you can comfortably afford your home without overextending yourself. If you're thinking about buying a home, keep your housing ratio in mind and make sure it fits your overall budget. If you found this video helpful, make sure to give it a thumbs up and subscribe to my channel for more mortgage tips. And if you've got any questions about housing ratio or anything related to home ownership, drop them in the comments or reach out to me directly. Thanks so much for watching the video, and I'll see you in the next one.